Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the news that moves those markets. And today we're going to start out with a couple more listener questions from last week. Eric, what do you got?
Yeah, we appreciate your feedback. We're not always going to respond on the comment section, but we will address a few questions each week here. First one coming from H. Vanderlyn, and he states, I don't understand why predictions are done based on technicals when it's totally clear that gold and silver react to news and policy.
I would encourage you, H, to listen to the entire program because we agree with you. Each week we start this program with a focus on technicals. If you'll listen to the end or watch till the end, we always wrap up with fundamentals. And so, yes, fundamentals are going to be the primary big mover in the metals markets. The technicals are showing you entry and exit points for trade strategy and certainly key resistance and support levels for you making decisions on when to step in.
And it's not just gold and silver that move off in news and policy. We got a perfect example of this last Friday when the jobs report was released. They were expecting 175,000 new jobs, got 75,000 instead, and the market reaction was positive. The Dow popped up, and there was actually an article from CNBC that said, the Dow rises 150 points after disappointing jobs data increases chance of a Fed rate cut.
Yeah, so now the markets respond positively to bad news. They used to respond positively to good news and negatively to bad news, and now there's some sort of hybrid response. And, you know, we hear often in the show too, and Miles, you're faced with this criticism often, and that is, why would you even focus on the technicals too? Because everything's manipulated in the gold and silver prices.
Sure, and that's why I'm sitting over here giving you the side eye across the table, because I know I tend to lean heavier on the charts, heavier on the technicals, but I would argue I have a very different approach to how technicals work, because I'm not looking at various pricing indicators based on history. You know, I want to look at a chart and I want to say, where did people get defensive? Where did people get offensive, and why? So I guess to some extent that can be brought back to the fundamentals of why were people bullish during this period of time? Why were they bearish during this other period of time? What do those different prices mean? But all the technicals are doing, if you're looking at them and using them correctly, is it's just giving you a snapshot of how people make decisions and why they're making decisions at those certain points.
Second question this week comes from Neil St. Leon. He stated, notice how platinum has barely moved. Industrial demand is weakening, and even these uncertain geopolitical issues are not moving it. It seems as though platinum may have seen its day.
I have to jump in on this one and just say, yes, we're back at where we were earlier in the year, but it has moved. It's moved quite a bit. We've seen a 16% rally, and we've seen a 14% reduction from the top of that rally back down. So you're looking at 30% volatility. That to me is a lot of movement. That's huge. That being said, at some point, yes, you can go back into any chart and find a period of time where you've been exactly here. And we did that, you know, looking on a 15-year silver chart versus a 5-year silver chart in a video that we produced. And if you go back 5 years, you can find that we were right here at silver, and you can go back 15 years and find the same thing. But at some point along the way, you're going to have absorbed a lot of volatility. Neil, in closing too, you also separated the two issues. One's geopolitical, one is economic. And you actually have to keep those separate. Geopolitics does not equal economics. And so you shouldn't expect a lot of platinum movement with geopolitics like you would with gold. Likewise, with the lack of economic viability globally, you shouldn't expect a lot of price movement in an industrial-based metal.
So getting over to the metals and what they have been doing over the last week, let's talk about some things that have shown us some good movement, starting out with gold. So for the last month or so, my assumption has been gold continuing to push down, possibly going down to that 618 fib in the 1240s. Lo and behold, a little bit of news, Trump v. China, and some shifting in the assumption of where interest rates are going this year. And we have a $65 rise in gold, going up from the 1280s to the 1340s. So
that's because that's a fundamental.
That is a fundamental.
That means that your technicals can't be perfectly predictive, to H's point originally.
Yeah, Tori, and that is a good point. I mean, you do get these massive runs by people, by markets, and even by producers or manufacturers or the money managers within these markets that fall back on their predictive analysis of what they think these changes in news or changes in trade are going to do to the markets. So gold pushing up into the 1340s is bumping us into that multi-year trend line. So initially, because we didn't really have a divergent move coming up Gold was still stepping down. We had this big correction up. You can almost argue that wasn't a correction. This could be looking at a trend change. Now, we won't know for sure until we're in the 1350s and we're setting some new highs above that trend level. But as we came into it, we've only had about a $20 drop, and lo and behold, we're pushing back up into the 1330s again today. So if we hold above this, once was support, then resistance, now it's support again. Line around 1322, 1325. This could end up looking very bullish for gold. 1350 is our breakout point that we're all waiting for, and then it's off to the races, well above 1400 and probably not stopping until we get into the 1500s.
Thanks, Miles. What about silver?
Silver, similar action, just more volatile. We came up to that 618 fib, we bounced back down. Same story with divergence, a little bit of a correction here after the big rise. Silver really needs to get above about 1510. 15's been this psychological number since like 2006 when we first came up and tested it. So it's not unreasonable to see it play around here for a while. But I'd argue, at least in the short term, the last month or two, 1510 is the real number we need to worry about, that we have to get above. And then we've just got a lot of noise between here and, let's say, 20, 21 bucks. So the interesting thing about noise is you could have a lot of different spots in there where the bears are willing to defend. But personally, I think they're scattered. I think you're going to see some bumps in the road at a few different price levels. I don't think there's some mainstream or major managed money position that they're willing to defend at 16 or 17 or 18. I think you've got a lot of traders in here that are going to be looking for places to take profit. So we start getting back up into the 15s again, and it takes off from there. Yeah, we're probably up in the 20s, low 20s, 21, 22.
Yeah, Miles, and moving back fundamentally, we've got a lot going on both geopolitically and economically. We've got next week about this time, we'll be hearing from the Fed. They're going to release the federal funds rate. You've got two different sides on this. You've got JP Morgan coming out a few weeks ago saying that there will be 2 rate cuts this year. Goldman Sachs came out earlier this week and said people are jumping the gun on this. They don't think there's going to be any rate cuts this year. Then on top of that, you have the U.S. budget being released today, and the U.S. budget gap is up $739 billion so far this year, about a 38% jump from this time last year.
That's just incredible to me, right? They're showing no signs of slowing down. In the weekly commentary a couple of weeks ago, we had Steve Hanke on, and it was really a fascinating discussion because he was talking about the fact that all hyperinflations are stimulated by irresponsible government spending and sovereign debt issues. And so here we are not learning any lessons that. And keep in mind, too, $700+ billion so far this year. We're not even through the third quarter. So the federal government fiscal year actually starts in October and ends September 30th. And so we've got that much period of time to go. We're well on track to blow past $1 trillion again this year. And we're already at $22.3 trillion in the federal deficit. And all we're doing is continuing that pace of growth. So is there any response to that? Currency-wise, dollar-wise, are we seeing anything markets in terms of those currencies?
Well, on a longer-term scale, the dollar obviously continues to tick up slowly that we've talked about for a couple weeks, but the dollar is down pretty hard, about 2% in the last week or two, pushing back down to the lower end of that rising channel. So with core CPI numbers out at 2%, which I always find we were joking about earlier. It's amazing to me they don't count things like oil and food in the core CPI numbers because apparently we as civilians don't spend money on those. But with core CPI numbers up, with the dollar rising slowly, I don't think we're looking at a strengthening dollar. I think we're just, again, the last life raft. I think the dollar is really the only thing keeping most of the rest of the world afloat.
Yeah, I think most of the effect is coming from the Eurozone, because we see as the dollars come off 2 points on the dollar index, the euro to dollar has moved from $1.11 that we talked about a few weeks ago on the show to now $1.13. And yet at the same time, we see most of the economic negative news coming out of Europe. So we just got through the G20. There was absolutely obviously meetings surrounding this global synchronized slowdown, and there was a lot of strategizing and a lot of speakeasy in terms of what they're going to do and what they're willing to do to try to stimulate the global economy, because all signs point to a recession right now. So do they have the arrows in their quiver? Who knows? We'll see.
Sure. I mean, Portugal, Italy, Greece, Cyprus, you got Germany trying to hold everything together. And this takes us back to our show a couple weeks ago with Deutsche Bank and how they've completely come apart at the seams trying to hold this together almost single-handedly in Europe right now since the market collapsed back in like 2009. So where else do you go with money? I mean, you have a recessive slowdown for the last few years in China. Europe is literally patchwork at this point, their financial system. The U.S. dollar can get away with it. And I really think that's it. I don't think there's growth. I think there's just getting away with it.
You can't have growth when you're talking about rate cuts. You kidding me? It's like Eric said earlier in the show. That's negative news. Okay, that's negative economic news that's rallying the markets. That makes 0 sense. Okay, and don't get sucked into the game. At some point, the credit bubble bursts again, right? And then we see this massive recession, and that's okay. That's healthy economic cycles. But where else do you go, Miles? Honestly, you go into gold. That's it.
Sure. I mean, it's the call to alternatives at this point. I mean, smart money's getting in early. I think the Bitcoin fiasco a few years ago is a perfect example of what happens when people are looking for alternatives. Now, that turned into a speculative crisis. But there's some realistic value in something like that, just like there's realistic value in holding tangible assets like metals or land to where you've got legitimate assets going forward for, well, in the case of gold, multiple generations.
Well, that's it for this week's Golden Rule Radio. Thank you for joining us this week, and make sure to follow us on Twitter at ICA Gold. And you can subscribe to this podcast by clicking the subscribe button below this video if you liked what you heard. Also, give us a call, 800-525-9556, as we would love to walk through your individual portfolio with you. Our website is McIlvaney.com, and we appreciate you listening.
Have a great week.